Welcome to this video presentation for Crypto Hedging for Miners by Bloc10, Blockchain FinTech. So what is the problem? If you're mining, and if you're not mining, then it doesn't matter what this is. If you're mining, you know what it is. You have a consistent influx of coin, Bitcoin, any coin that you're mining, it doesn't matter. Every week, every day, you're earning coin. That's wonderful. Problem is that the crypto markets are very volatile. So what happens if Bitcoin is down in 20% and you're mining Bitcoin? You had a $1 million profit, it would be 800,000 in that time. Conversely, if the market goes up, that's also a problem because you want to capitalize on those gains, but when to sell? When Bitcoin is in a bull market, it can go up ridiculously. I don't even want to say a number, it's so ridiculous. But remember in the fall when it went from 10,000 to 15,000 to 20,000, how would you know if 20,000 is the top? So this is where hedging comes into play. Miners don't have a way to automatically optimize the profit of these income streams. What if the coin goes down by 90% while you're holding it? What happens then? So what is the solution? Active hedging. And this isn't something that we've invented. We've just done this for 15 years for corporate FX treasury departments. So for example, take a company like McDonald's. They get 60% of their revenue outside the United States. McDonald's has a very active FX hedging program. If they didn't, they wouldn't be profitable because so much of their revenue comes from euros, Great British pounds, Russian rubles, Swiss francs, and practically every currency in the world. So hedging is not really any different. The concept of active hedging is not passive hedging. So the difference is in passive hedging, you just create an exact hedge. It's one-to-one. You're not going to make any money. You're not going to lose. It's just flat. Active hedging means you have a market position. So for example, if the Bitcoin market is going up, we're going to hedge. If it goes down by buying puts, perhaps, or selling calls, we might do a mix of both. But we have an overall market view that in the next 2 weeks, the Bitcoin market is going to go up. So we're going to try to capitalize on that by selling at multiple peaks. So for example, the price goes up by a couple percent in an hour or whatever this is the time frame, we're going to sell 20% of our position. Then it goes up again, we're going to sell another 20% and so on. So this is active hedging. So active hedging requires more management, and that's where Bloc10 comes in. We can do this job, but it also optimizes the profit. So we're going to capitalize more of the gains, and we're going to minimize the losses when the market is going down with use of derivatives. Bloc10 will set up this custom hedging program for you, and every program is different. So it depends, obviously, what coin you're mining. It depends on the size of the mine and just a number of variables, what your goals are to achieve. Maybe you want to be more conservative and just limit your risk of loss as much as possible and not worry about leaving some profit on the table. Or maybe you want to be more aggressive and try and maximize on all your profit potential as the coin is going up. And maybe there's some market making opportunities if you're mining a coin where you control almost 20% of the supply, there's some opportunities there as well. So we can optimize that for you. We would start with a financial survey to determine what your needs are and create a structured program around that and then execute it for you. And there would be no end to this. It would be a month-to-month contract, which would indefinitely last as long as you're happy with our services, which you would be. And it can create profits in addition to eliminating risks. So the important thing to understand about active hedging, it's not speculating. It's taking your underlying position, which is long the coin. We're going to hedge if the coin goes down, and we're, instead of just creating a flat hedge, we will create an active position with a bias, and our bias is to sell as high as possible because our underlying position is always long the coin, because every week, every month, we're going to get more and more coin. So how do we do that with active hedging? We use derivatives like options, futures, and other instruments that we implement in the hedging plan. So our model is we charge a flat monthly fee for this service, which eliminates any conflict of interest. So imagine the reverse. Imagine if we charge just a commission on each options trade that we placed for you. We would have an incentive to trade as much as possible, or any of our managers. If this grows to a big business, we're obviously going to have a team of traders who are managing this, and any trader is going to be negatively incentivized to churn the account if there's a per trade commission. So the best way to do this, and we have a lot of experience in different scenarios, is just to charge a flat fee, which would be a percentage of the assets, similar to a management fee, like a percent, for example, of the assets under hedging management, or a 0.25%. It depends on the circumstances, but it would basically be a management fee that we would be paid monthly, but it would be calculated annually, calculated from the total amount of hedged assets. And that's actually pretty common in this business. It's not the only approach towards fee management, but in our opinion, it's the best one because it eliminates any conflict. It means we're going to get that monthly fee, we're going to do the great service, and we're just going to try and make as much money for you as possible with eliminating the risks as much as possible. And we have no incentive. We don't have a percent of the profit. We just are going to give the best hedging strategy that is even possible, and then some. So that's the best way to approach that potential conflicts. So in that scenario, the customer would open several hedging accounts. So there are places where we can get options. So the customer would need to open accounts at those exchanges or brokers in the name of the customer. So everything will be in your name. So the only thing you would do is pay us our fee, and everything is in your name. We would need access to those accounts in order to buy and sell the derivatives and other instruments we would use for hedging. And we can set up custom instruments if they don't exist for your coin, which is another reason why the flat monthly fee is so good in this case, because a lot of these newer coins, like some of them that we discussed on our last call, they don't maybe have puts and calls, but we can create them in partnership with some brokers. So it's a lot of work to set up, but it's not a complicated business, so there's not a lot of unknowns. We can do this. We've done it before. It's not a problem, and there aren't any things that might surprise us. Active hedging means actively managing positions to offset the natural long position in the coin with a goal to optimize profits. That's the killer sentence. So here are just a few ideas, some solutions we might integrate in a custom hedging program. One is a sell-only strategy that sells into strength. So for example, there are margin brokers that offer Bitcoin, Litecoin, Dash, Bitcoin Cash, and Ethereum as margin products, which means we can have 20, I think up to 50 to 1 leverage. We can develop an algorithm which would sell into strength. So let's say as Bitcoin is going up, it's going to be selling into the strength. So this eliminates the need for a single exit point. That means we don't need to determine what is the high of Bitcoin this year. We're going to be selling into every bull market up move. That's one idea. Another idea is we could create market making strategies, which are execution algorithms for big sell orders that won't affect the market. So let's say you're a miner and you just want to convert your coin to Bitcoin or Ethereum or cash, but you don't want to just flood the market with sell orders. So what we can do, we can create an execution algorithm, which is the equivalent of a market making strategy, because market makers typically are on the sell side. Traders are typically on the buy side. So what that means is the Bitcoin miner has a natural sell tendency because the miner is always accumulating coin. So what we do in order to not impact the market, because let's say that you have, just for extreme example, you want to sell $1 billion US worth of Bitcoin. Well, first of all, you're not going to be able to find someone who will buy in one order. So you're going to have to just keep selling and selling and selling. And with all that selling, what can happen? The price can go down. And this exists even in FX, which is such a big market. It's a $6 trillion a day market. But even in FX, if you have $1 billion or a $10 billion order, you might have to work it over a period of days or even weeks not to affect the market, especially if it's in an exotic pair like Russian ruble or something which is not commonly traded like the Euro USD. So what we would do is create a market making algorithm that would sell over time perhaps when the market ticks up, or it would sell to certain buyers. We could analyze the market and see if someone is buying a lot, we might hit that bid a lot with our sells. So it can be a little complicated as far as how to execute it, but the concept is simple to understand. We just don't want to sell all at one time. We want to create an algorithm that's going to spread out that sell order over a period of time, that it just drip feeds it into the market. Then there's a third strategy, which is perhaps one of the most interesting for the miners, which is selling covered options with the coin itself to generate income. So what is a covered call? A covered call is when you have the underlying. So let's just talk about stocks for a minute, because it's a lot simpler. And this is something that a lot of people do with their own 401ks. So let's say that you own Apple stock, and you own it for 10 years, and you just want to sit on it, and it's in your retirement. You never want to sell it. You own Apple stock. So what can you do with that stock sitting in your account? It goes up, it goes down. Overall, you hope that it goes up. So what many investors do is they sell covered calls on that Apple stock. So what that means is you're selling someone the option to buy it if it hits a certain price, which is going to be higher than the price it is now. So there's a couple risks here. One is, if they execute that option, you're going to have to sell them that stock at the price which is agreed. And the price will determine how much money you generate from that option. So if, let's say, now Apple is trading at 100 and you sell the covered call at 150, if it hits 160 and they choose to execute that option, you must sell them at 150, which you can afford to do considering you bought it at 100 or less. As long as you're in the money, you're going to give up potential profit over 150, but you're not going to lose anything, and you're going to get the income that they're paying you for that right. So covered calls are a great way to generate income, with the known risk that a day could come that you might lose your stock. But many traders are willing to give that up in order to generate the short-term income. In fact, there's entire trading and investment strategies which are just buying stocks and selling covered calls on them, because you own the stock. So there's not the naked options writing risk that would be associated with if you didn't own it. And the income from selling covered calls can be pretty good. So that's something to look into, because it's not popular in the crypto world now, but it's starting to be. There's LedgerX, there's just a number of options platforms that are starting to pop up. So this is something that we would want to heavily look into for miners, because miners have an underlying long position in the coin. So selling covered calls on the coin would be a great way to generate income, keep the coin, and if they have to end up selling it at a higher price, then anyway they want to get rid of it. So this could be really good for miners. Just a little bit about our experience. We have 15 years experience as FX quant trading, development, and related operations. We've created hedging programs for large institutions and executed them. I am a registered Series 3 associated person since about 2005 with the NFA, and we are trained for commodity hedging. I was a commodity trading advisor and an introducing broker for more than 10 years in a registered capacity, and recently got the Series 30, which is a managed futures associated person. And we have developed more than 1,000 quantitative currency trading systems for profit and hedging. Actually, some of those algorithms we developed were specifically for hedging. So we have done hedging strategies, because just like for the miners, if you're in international business, you need to hedge. 50% of corporations are hedged and 50% are not. That's publicly traded companies. That means half of publicly traded companies get it and half don't. So something like McDonald's understands hedging. They're very good at it. They have a very strong hedging team. They execute it, and they've never had a big loss due to currency headwinds because they hedge. Other companies are not so sophisticated. They'll lose $1 billion because the dollar went against them, and they'll just say, well, currency headwinds, oops, we just lost $1 billion because the dollar is strong. So it's really, really necessary for miners to understand that hedging is a necessity for your business, because Bitcoin and all the other coins that you might mine are very volatile, and they're going to continue to be volatile because they're cryptocurrencies. We also have a options and hedging expert that managed the FX options hedging desk for Ford Motor Corporation for 30 years, and he will be the chief dealer managing the desk for hedging of big minor clients. And we have more team members. We have a couple that are very experienced at this, that we've been doing it for donkey's years, as they say. So we really are in a great position to offer a very high quality hedging service. And you can see for free totalcryptos.com. That is our website that offers cryptocurrency data on more than 2,000 cryptocurrencies. And we do have a professional crypto data service called ZData, which is like the Bloomberg of cryptocurrency as far as offering data. We have 100 sources. We do a lot of things like data filtering and FX conversions, all offered through an encrypted real-time API to your website or to your trading related platform. We are Bloc10, blockchain fintech. This concludes our presentation. We look forward to hedging your mining risks. For more info, you can go to totalcryptos.com.